Welcome back to the McGraw Commercial Properties Update Live. This is the multifamily group. We have Kerry Velez, Ryan Gorman, Jeremy Smith, and Gary Crispin here to talk about the multifamily division. And it has been almost exactly 3 months, almost a quarter since our last update. So things have changed in the course of a summer. So let's get into it. Kerry, how has the pandemic affected transaction volume and investor activity over the last couple of months?
So what we've seen over the last 6 months and the first half of this year, total transaction volume that's been recorded is right at 55 billion, which sounds like a decent number, but when you compare that to last year's total of 190 billion, it's a pretty stark drop off.
So it was 190 to this date last year?
It was 190 billion for the entire year.
Okay.
For 2019, and each of the previous years exceeded 150 billion. And so what we see now is in this first half, in the first quarter, it was pretty much running steady. Everything was going along in line, and we were looking to have another record year. But in the second quarter, we saw that drop off with all of this coming into play. A lot of uncertainty came about, and we've seen that taper off. We could see it kick back up towards the end of the year, but I don't think that it will get there due to what's also being seen in the lending climate.
That was going to be the add-on question. What are you seeing in the lending climate? That's got to be prohibitive.
So far this year, 73% of the new loans that have been issued have actually been refinances, which is up from 61% from last year. So there's a lot of people going in there instead of trying to sell their property, they're going in and wanting to try to capture some of these improved rates. The overall lending rate now, the average interest rate is 3.6%. Last year, at the same time, it was 4.5%. So we've seen almost a full point increase or improvement over last year. But that's a lot of people trying to just refinance, trying to weather the storm. And with the lending climate coming in and requiring more reserves for principal and interest, it's changing people's equity returns, and it's having them readjust the way that they're having to underwrite properties, which has slowed things down a lot. We haven't seen the drop off in values that we were expecting to see. A lot of people thought that was going to happen, but it's not. So right now we're in this state of everyone's trying to get to weather the storm. Everyone is looking at what could possibly happen. There's a lot that's going to come to play as we see what's going to happen with the government and the stimulus package. But right now, that's where we're at with all these numbers.
Well, some of that also has to do with rent collections, investor activity, all of that sort of stuff. Ryan, how has it affected renter activity? You got to keep an eye on that as an investor, I would think.
Actually, with renter activity, it's at least in the Tulsa market and our surrounding markets, Northwest Arkansas, Oklahoma City, the occupancy rate has been extremely high, and the collections has been outpacing last year. So even though we've went through a pandemic, people, at least in our region of the country, are paying rent.
Now, the devil's advocate is, they're paying the rent because they're getting money from the government. Is that continuing once those PPP loans stop? This is a crystal ball question.
Most of the renters aren't getting the PPP loans; they're getting the different stimulus checks. But for the most part, the people that rent in this market, the jobs have opened back up for them. There are always a few people that have fallen through the cracks, and there are those certain issues on properties. But when you're talking about a property of 400 units or 300 units, and you have just a handful that aren't paying rent or are a little behind, the collection rate is still very high. As for the last 4 or 5 months or going through this process, we've seen collections exceed 99%.
Exceed 99%. And is that across all investment classes? Is that A, B, C, and everything?
The data that I have is from C and B classes.
Okay. I wonder, and maybe have you had any feedback from A property owners as to whether or not that falls in line with the trend?
I have not.
No.
But the majority of polls that I've been doing is strictly B, C, and those are exceeding expectations.
Yeah, let me hop in here real quick because I've talked to several A property people in the past 2-3 weeks. I've been making a lot of phone calls on A properties, especially in the Northwest Arkansas those trends hold for them as well.
Right.
If anything, actually, they are surprised that they are seeing more move-ins than what they would expected in the A-class properties. With the downturn, in the economy, the A-class owners were thinking, well, where my rents are, that's going to price me out. But they're actually seeing almost the exact same thing as the B and Cs.
What about relocations? I would think, just looking at the economy and the pandemic, people are just sheltering in place and they're not relocating to other properties. Is that the case?
Well, I think we're having relocations from other
Yeah.
cities or coasts coming to the south central of America. I think that has a lot to do with these high occupancy and high collections. I'm not saying everybody from New York City is moving to Tulsa or Northwest Arkansas, but I do think it is on an uptick.
That falls in line with things that we had talked about even last year, early on this year, that we have a shortage in the housing market. We have a shortage in neighboring city housing markets, and we couldn't point to any one particular thing other than, I think, Ron, you brought it up in the team meeting in like January, February, is like, where are the people coming from? Like, why are the numbers so good, right? Occupancy's high across all residential classes, apartments, single family houses.
Well, when you have job growth and wage growth, which our kind of region does, I think you're going to have population growth that people are attracted to that.
And Gary, I'll focus on you as the elder statesman here, have seen a few ups and downs. What sort of trends do you think that we can expect in the multifamily sector over the next several quarters or to year?
Neil, I think our sector is going to be strong. There's a lot of speculation that the sky is falling, but it didn't.
Right.
I agree with Ryan. I checked with 3 of the largest owner management companies here, and they're amazed because we've held at the high 90 occupancy, collections down maybe 2 or 3%. So I think it's going to be healthy in the near future. I will say that there's a lot of speculation now that the unemployment $600 payments are going to end, that there'll be mass evictions, and I asked these owners about that, and they said, most of our tenants have made arrangements, they've paid what they could, and we're going to honor that because we think things will come back, and it's ultimately cheaper to keep them than to replace them. And just one more point, I just saw in CoStar that UDR, which is based in Colorado, owns 51,000 units. They say that their eviction rate, should they have to do it now, will be 800 units out of 51,000. So about 2%. And everybody else is staying on full rent or some arrangement.
Yeah, I said PPP loans earlier. That's for our office and industrial clients. Stimulus checks here is it's important. We've got a lot of things coming up in the latter part of this year with an election. You have uncertainty about the pandemic and uncertainty about the stimulus funds being continued. Do you get a sense from the multifamily owners that this is something where they're just waiting for the other shoe to drop, or just kind of playing it safe?
I get both. You have, and I would say for me, the majority of the owners are not just sitting around waiting and playing it safe.
Right.
They're making strong investments now.
Right.
We have a lot of people that are using this time and the low interest rates and the fact that the market's still strong to almost double down, if you will, by selling smaller properties and picking up a much larger unit, adding to their investment. You have a lot of people doing that, and I think that's a really smart play here, because as we've talked, the multifamily sector is poised to stay strong and to continue to be a good investment. And I think that's why you see a lot of people either doubling down, or also, you do see those people out there refinancing, and the reason they're refinancing is because they know it's a strong market. They're not running for the hills.
Right. If you're a new investor right now, regardless of your income or buying ability, what sector is your favorite? Ryan, what's your pick right now if you're getting into the multifamily market?
You know, anything that has an opportunity, and we can find opportunity anywhere, whether it be look to see a poorly run property from apathetic management that really isn't collecting everything that it should, or just not being efficient. If it were me, I would look for any property over 100 units so that you really have that multiplier effect when you raise rents slightly, and look at things to run more efficiently, like water feasibility studies, or if you're looking at newer properties or just increasing occupancy. There's lots of way to put small value add on property. So I would agree with Jeremy on that past statement. The interest for new property owners and old investors is very strong right now.
Is there one particular class from an outsider looking in, knowing what I know about the multifamily market? There's people that and companies that tend to get in and they really churn inside the multifamily market, and so they acquire more and more units. And the idea is to continually to ladder up in size and price and geography. Is there one popular property type or size range that those folks are focusing on right now?
I think the only type that has the most interest is if a property has over 100 units. When
Okay.
it comes to class or location, from what we've seen, or at least what I've seen, each group or investment firm really has a lane, and they kind of stick with it. So if they have a solid B model, solid slight value add, that's their focus. Some groups just look at the newer properties and A properties. Some groups look on new build. Some look on C class and completely remodel that to B plus. So it really depends on the investment group. And what we've seen is they usually try to stay in their lane or what they're good at.
For investors looking at investments across the board, one of the key measures in real estate is going to be a cap rate. Where are cap rates right now in multifamily? And that's kind of a loaded question because I know you can segment them by class. Carrie, do you want to take that one?
Yeah, so overall cap rates really haven't compressed the way a lot of people thought that they were going to, or increased either. We're sitting at nationally, we're sitting at about 5.4% average across the board. That could change over the next 6 months depending on how things go. But for cap rates, for what we're seeing in our market offers a lot as far as Oklahoma and Northwest Arkansas. The cap rates that you can purchase at are a lot stronger than what you're going to be able to see in some of those other markets, especially say in primary markets where it used to be a lot more attractive and have a lot more notoriety, but people sort of seeing 4% cap rates on properties. And even in Arizona, for example, we were looking at some properties for an investor there, and there were properties that were built in 1985 that were considered Class A, and they had sold recently for 4.8 cap rates, which is unheard of here in Oklahoma. Your top number is going to be about 5.25 for a Class A property. And if you're looking at Class B, you're probably looking at 6 to 7. As far as people valuing strictly on cap rates, I think people are getting away from it a little bit just because of the way the lending is gone. I think the fact that you can get loans at a much lower rate now is going to help people push those numbers a little bit. But across the classes, we're looking at about, in our market, 5.25, 5.5 for Class A, 5.75 to probably 6.5 to 7 for a Class B, depending on where it falls in that Class B, and then getting upwards 7.5 to 8 or so, 8.5 to Class C.
We skipped over it a little bit, but there's been some start and stop and some restrictions with Fannie and Freddie. Where are those at right now?
Well, the latest that we're hearing is, because of COVID and in the economy and everything, that agencies that Fannie and Freddie are making a buyer or a borrower escrow up to 18 months of principal and interest. That's their money, and they get it back after certain requirements in that, but it adds to your equity.
Right. So if you're raising cash, you have to account for
you sure do.
18 months of
Yeah.
payments.
So,
Okay.
and that's pretty much universal in my understanding. Now, I think if you do bank debt, that's not a requirement.
And your lending rates right now, what are you seeing percentages from the
Oh,
agency debt?
and we just got a quote on a deal in Joplin that was at like 4%.
Okay, so 4% money from agency debt
Yes,
with some higher restrictions.
right.
Okay. If you went traditional financing route, maybe some regional banks, is that even advisable? What would you be seeing if you went that way?
By traditional, do you mean bank debt?
Yep.
Well, banks probably don't have the reserves. They can be competitive on interest. They're rarely competitive on term of the loan. So you're looking at 20, 25 years typically,
Right.
and that just increases your debt service. So it
Right.
just depends on the deal if that works.
Right.
Got a few examples of some interest rates out there. A property that we had represented and sold last year, the new owner has refinanced it for 30-year AM to 2.91% interest. I'll repeat that, 2.91%. That's the best I've seen.
On what sort of LTV? Is it
It was
60?
on a 65 35 LTV. The other ones I've seen for an 80-20 bank debt, I've got 3.9% is the best I've seen. That's out of Northwest Arkansas. Agency debt we've seen as low as 3.5%. It kind of hovers between 3.25 and 4%, depending on the market and the property. And that's obviously a 30-year amortization schedule, as opposed to I think the max I've ever seen or in this market a local bank do is 25-year AM.
Good summary on the rates, good summary on the AM, good indication versus agency versus bank debt. So we've covered kind of the lending environment. Rents are still being collected. Owners are satisfied with that. Smart ones are doubling down. They're expanding. Occupancies continue to remain high. Rent collection is high. We've covered a lot of territory in regards to our update here. Last question that I had, I think from you guys, I'll turn it around to you. Is it a good time to invest in multifamily, A? And then B, what would you go after?
Go ahead, Gary.
I think it's a great time to invest. If you're looking for bargains, they're not there, in my opinion. I mean, all our properties are sound. We have any number of investors that are looking for product. And product is the toughest thing to come up with.
Right.
Because a lot of people are happy with their investment and they don't want to sell.
Talking about any number of investors, part of the reason for doing a lot of this is not only to share information with our existing clients, but also to give information to everybody else out there that is in the multifamily world, is interested in seeing what we come up with, seeing opportunities in the different territories that we cover. Again, Kerry Velez, Jeremy Smith, Ryan Gorman, Gary Chrisman, part of the multifamily division here at McGraw Commercial Properties. Guys, I'm going to wrap it up. Do you have anything else you wanted to add?
The one thing I would add to this is looking forward. You were asking about some opportunities and where people might want to look to put their money. And this is being seen in a lot of municipalities. It has been seen prior to COVID-19 coming around. But the affordable housing market is something that I think is becoming much more popular and much more attractive. Previously, affordable housing was considered like Section 8 stuff for people who could not afford it without some sort of government assistance. But with the way things have changed, it's actually come to be more defined as just those lower rent properties. And with the increases that we've seen in occupancy in C and B class properties, it's showing that the trend for a lot of people who are renting, even those who can afford their own rents, are moving downwards towards those properties that are having that have lower rental rates for the tenants. When you look at some numbers for like new housing starts, a lot of people were looking to buy new houses. So for like new housing starts, the percentage of those houses that were smaller, say under 1,800 square feet, those have decreased, and the larger housing construction has increased. So it's put home ownership out of reach of a lot of people who are trying to get into it. And one of the things that we've seen with COVID is that it's sort of exposed of a fragility in American financial planning and the individual financial planning, where people who thought they were doing very fine and they were sort of renting on that higher end are now seeing, hey, I might want to scale back and pull back. So I would see people getting into those markets, getting into those properties where they can offer affordable rates in decent product. They're going to see really strong returns, and it's going to allow them to weather this out and to make it through this. And then they'll have properties that people actually want to stay in.
Well, every day we see new economics unfolding, and it'll be interesting to track the trends of what happened this year. Is certainly a case study for what happens in years down the road. So all good points, gentlemen. I really appreciate your time. Thanks for the quick update. And if you have any questions for the multifamily division, main line is 918-388-9588. That's 918-388-9588. And our website, McGrawCP.com, MCGRAWCP.com. And then all of the emails and bios, et cetera, are on that website. So guys, I appreciate it. Thanks for your time. And we'll do it again here in about another quarter.
Sounds good. Thank you.
All right. Thanks, guys.